Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Snowflake Inc. Annual Report. Snowflake Inc. offers a range of businesses and services through its cloud-based data platform. The company's primary service is the AI Data Cloud, which enables customers to consolidate their data into a single source of truth. This platform allows users to build data applications, share data and data products, and apply artificial intelligence for solving business problems. The company serves various industries including financial services, advertising, media and entertainment, retail and consumer goods, healthcare and life sciences, manufacturing, technology, telecom, travel and hospitality, government and defense, and the public sector. Additionally, Snowflake has partnered with OpenAI to develop AI solutions that deliver tangible return on investment for joint enterprise customers. In essence, Snowflake Inc.'s services can be categorized into three main areas: data consolidation and management, data application development, and AI-powered business problem-solving. The company's platform is designed to provide meaningful business insights and drive growth across various industries. Snowflake Inc. market capitalization of $58 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Snowflake Inc. holds a significant advantage in their industry. Snowflake Inc. trades at a higher price-to-book ratio of 29.89 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 67% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for various companies can be attributed to several key factors. Capacity arrangements, which account for a significant portion of revenue, saw an increase of 2% from FY 2025 to FY 2026. Additionally, compute resources consumption and data transfer resources consumption rose by 10% and 15% respectively in FY 2026. Professional services revenue also experienced a notable growth of 12% year-over-year in FY 2026. Furthermore, the introduction of new revenue streams, such as marketing to public sector customers, contributed significantly to revenue growth. Changes in accounting treatment for software development costs under ASC 900 and 85-20 also led to an increase in revenue. These factors collectively resulted in a 28% increase in revenue from FY 2024 to FY 2026. On the other hand, some companies experienced decline in revenue due to decreased storage resources consumption and other revenue streams. The purchases of investments also led to a decrease in net cash provided by investing activities. However, these declines were offset by growth in other areas, resulting in overall revenue growth for many companies. The financial performance of a company has undergone significant changes over the past few years. Net income has seen a decline, decreasing by 28% in 2026 compared to 2025. This decrease is attributed to substantial losses incurred by the company. In contrast, profit margins have also experienced a downturn. The gross profit margin decreased from 68% in 2024 to 65.9% in 2026, while the operating loss margin increased from -39.1% in 2024 to -30.8% in 2026. The reasons behind these changes are multifaceted. Increased costs and expenses have put pressure on profit margins, while competition has also played a significant role in downward pressure. Additionally, changes in tax laws and regulations have further impacted the company's financial performance. These factors have cumulatively led to a decline in net income and profit margins, indicating a challenging period for the company. The company is indeed generating positive operating cash flow. This can be seen in the net cash provided by operating activities, which has been steadily increasing over the past 3 years. In 2026, the company generated a significant amount of $1,221,900,000 in net cash from operating activities. Similarly, in 2025 and 2024, the company generated $959,800,000 and $848,100,000 respectively. The data also confirms that the company is generating positive operating cash flow, with amounts exceeding $778.9 million, $884.1 million, and $1,120.3 million for the years 2024, 2025, and 2026 respectively. This trend indicates a consistent ability of the company to generate sufficient cash from its operations to meet its financial obligations. The company's debt level and interest expenses have undergone significant changes over the past few years. One notable change is the increase in total liabilities from $6,027,295 in 2025 to $7,208,393 in 2026, indicating a rise in debt level. This increase in debt has led to an uptick in interest expenses, which were previously zero for both 2024 and 2025, but jumped to $8,298 in 2026. However, it's worth noting that the company also experienced a decrease in interest expense from 2025 to 2026, with a reduction of $5,539,000. This seeming contradiction can be attributed to the fact that the interest expenses were already at zero for both 2024 and 2025, making any increase in 2026 a significant change. Overall, while there are some fluctuations in interest expenses, the most notable trend is the increase in debt level and corresponding rise in interest expenses. This suggests that the company's financial situation has become more complex and potentially riskier over time. The management is optimistic about the company's outlook, citing increasing revenue over the past 3 years driven by its platform delivery model. The company has made significant investments in strategic equity securities and acquired Observe, Inc., a provider of AI-powered observability platforms, to expand its offerings and capabilities. While the company faces challenges related to foreign currency risk and asset impairment charges, management is confident that it can mitigate these risks through careful financial planning and management. The company's strong cash flow generation and sufficient liquidity provide a solid foundation for future growth and scaling. Management's strategy focuses on growing and scaling the business through strategic investments and acquisitions, while also addressing the challenges posed by foreign currency risk and asset impairment charges. Overall, the outlook appears stable, with opportunities for continued revenue growth and expansion into new markets. The company has made several significant acquisitions in recent years, expanding its capabilities and presence in the market. The first notable acquisition was Crunchy Data Solutions, Inc., which was acquired on June 6, 2025 for $164.5 million in cash. This was followed by the acquisition of Observe, Inc., on February 2, 2026, valued at approximately $596.2 million. In addition to these two major acquisitions, the company also entered into business combinations with Datavalo and Samoha in 2025 and 2024 respectively. These deals further solidified the company's position in its industry and provided access to new technologies and expertise. Interestingly, there have been no divestitures mentioned in the extracted summaries, suggesting that the company has focused on growth through acquisitions rather than shedding assets. Overall, these strategic moves demonstrate the company's commitment to expansion and innovation. The company's financial strategy has been focused on share buybacks rather than dividend payments. According to the provided information, the company has a stock repurchase program with a total authorization of $4.5 billion. This indicates a commitment to purchasing shares from the market. Throughout various sections of the document, it is mentioned that the company has indeed bought back shares. For instance, on page 36, it is stated that the company has bought back shares, repurchased stock. Additionally, specific numbers are provided to illustrate the extent of share buybacks, such as the repurchase of 4.9 million shares for $873.5 million in January 2026. In contrast, there is no clear indication that the company has paid dividends on its capital stock. In fact, page 48 explicitly states that the company has never declared or paid any cash dividends on its capital stock and does not intend to pay any in the foreseeable future. This suggests a deliberate decision by the company to prioritize share buybacks over dividend payments. Concerns about inventory buildup or supply chain disruption are indeed present. The global economic landscape is experiencing volatility due to tariffs and trade wars, which can significantly impact global supply chains. This uncertainty can lead to stockpiling and inventory buildup as companies try to mitigate potential disruptions. Furthermore, government procurement requirements and compliance burdens pose additional risks to supply chain stability. Companies must navigate complex regulations and bid protests, which can slow down the procurement process and disrupt supply chains. Moreover, sales to highly regulated entities are subject to supply chain restrictions, adding another layer of complexity to the issue. These factors collectively contribute to a heightened sense of risk in global supply chains, making it essential for companies to develop strategies that address these concerns and ensure business continuity. That concludes the financial summary for Snowflake Inc. Feel free to comment below, and I will be happy to answer them when possible.